In this video, we will go over the closing process. It is the last step in the accounting cycle. We have made our adjusting entries and prepared our financial statements already. So now we're ready to get prepared for the next period. It's like a scoreboard after a basketball game. Once you're done with the game, you get ready for the next game by zeroing out the scoreboard. So we want to do the same thing with some of our accounts. We want to zero them out to get ready to start the next period. So these accounts are our temporary accounts, and we want to zero these out. And the other accounts you see here are called your permanent accounts. These accounts are called permanent accounts because they don't close to begin the next period. So the ones we're going to be concentrating on are the ones that zero out. So when we say we want to close the temporary accounts, just like a scoreboard, we want to get the balance back to zero. We're going to do this in two steps. In the first step, we're going to close revenue and expenses to capital. And in the second step, we're going to close drawing to capital. So those are the two steps. So when we say close, we mean get the balance to zero. So let's look at the first step, close revenues. So when I look up here at revenues, I have two revenue accounts. I have $30,000 and $6,000. So if I want to make these two accounts go to zero, I need to debit fees earned for $30,000 and debit interest revenue for $6,000 to get these two balances to zero. And if you look down here at the journal entry, I have zeroed out fees earned and interest revenue. Next, if I want to zero out salary expense, it has a debit balance of $5,000, so I would need it to credit it. As you can see, I would credit salary expense for $5,000 to get it to zero, and I would credit rent expense for $4,000 to get it to zero. Now notice it says close revenue and expenses to capital. That means I need to transfer these balances to capital. So if I add up my debits right now, I have $36,000 in debits and I have $9,000 in credits. So what this means is if I have $36,000 in revenue, and really this is $9,000 in expenses, the difference is net income of $27,000, which is what I'm trying to transfer to capital. So what I'm going to do is I'm going to transfer this to capital. So I need to see if I need a debit or a credit. My debits are 36. I need my credits to also be 36. So I put it on the credit side, and now my debits equal my credits. Another way to remember you need it on your credit side is that capital has a normal credit balance. Net income increases capital. So if we credit capital, that is a positive impact. In a minute, we will see if we have net loss, that is a decrease to capital because a net loss decreases capital. The next step is to close drawing to capital. Here's my drawing account. Right now it has a debit of $1,000, so I need to credit it for $1,000 to make it zero. So I have credited drawing for $1,000 and I need to close it to capital, so I will need to debit capital. And this makes sense because drawing makes capital go down, so I will need to debit capital. And that completes the journal entry. I would post this to my ledger and that would update my accounts. I would be left with zero in the temporary accounts: drawing, fees earned, interest revenue, salary expense, and rent expense. And right now I have $131,000 in capital, but after these entries I would have an updated capital balance. So it has a credit balance, which is a positive capital number. And I look at my entry and I see what I've done here. I've credited capital for $27,000. Then I debited it for $1,000. So my new updated capital count would be $157,000, which is $131,000 plus $27,000 minus $1,000. So here's my new updated capital balance. So now we have one more trial balance to prepare, which is the post-closing trial balance. So when we prepare this, all of the numbers up here are going to stay the same, these up here. But then capital becomes $157,000. And then all these numbers get zeroed out because we've zeroed them out with our closing entries. And we can see now that we are in balance because all of these numbers here were transferred into capital. And since these are zero, we don't even have to include them. So we can actually have a shorter trial balance. And this one is now called post-closing trial balance. And I'll do another video on what it would look like if we had a net loss. Let me know if you have any questions.